Buy the dip, short the market. Which one is it? Everyone has a different interpretation of what may happen, but the truth is no one, including myself, can predict what's going to happen. But we can look at history to kind of align ourselves to decide whether or not this is a good time for us to enter into the market. So first of all, let's just look at history. Below here is the rate of change, where it's 5% in a day. The only time we have seen this is in 2020 right here. And what this means is capitulation. Look at this. This is capitulation. Everything is going down. So historically, when the rate of change goes below, like really it goes like 5%, the next few days, there is always a retracement back up. So keep this in mind that for every major down day, almost every major down day that exceeded 5%, within the next 1 or 2 days, there is a bounce back up. So if we do see a huge bounce back up, number one, it is expected. It does not mean that the bull market has happened. This has happened 1, 2, and like 2.5, and then 3 down here, and then 4, where it crossed like the 5% level, and it had one green day afterwards. But that did not mark the end of the bear market. Which is why everyone who says short the market did kind of get it right, and everyone who said buy the dip also kind of get it right. The question is, how long are you going to hold that short position or long position for, and whether you're comfortable with this kind of whipsaw effect. Now, I'm going to show you what I'm going to do, okay? So I'm not a genius. I don't think I can predict the markets. I'm just looking at probabilities and statistics to make my decisions. And so this is what the stats say. This is the McClellan oscillator right here and the high-low index. This is the put-to-call ratio and the VIX indicator. When the high-low index dips below close to 5%, then I'll buy the dip, because that's when I know capitulation has happened and it may be a good time to get in. And then down here, the McClellan oscillator, I also want to see this fire. If these two don't fire, I'm not going to be entering long into the market yet. And I know that I may miss an opportunity to go long, but I don't want to take just any opportunity right now. I'm going to take and be patient, wait for a calculated move before I take such an opportunity. And then down here, the put-to-call ratio, ideally, I want to see it cross this line above here and then reverses back down. And if you look at the VIX, right? I want to see the VIX cross this line as well, right over here. Because historically, when the VIX crosses this line, which you can kind of see by this red dot, it has indicated a bottom and a bounce. For example, this bounce right here, it coincided with this white line, which is the McClellan oscillator and the VIX. They fired, boom, it marked a bottom. Right here, right, it touched the VIX right here, boom, it fired, and then there is some sort of retracement. So until I see the VIX fire, I statistically am not too confident on the market. Ideally, I want all of it to fire together. That would give me the greatest confidence. But this is not to discourage anyone from going long right now. Again, if you look at 2020, if you went long at any point during the downturn, you waited for 1 year, you would have made a lot of money. But in terms of a swing trading perspective, which is where I'm coming from, I'm not going in yet, and I'll let you guys know when I go in. And so this is a video for anyone who is just wondering what I'm doing right now.